Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. We haven't talked about commodities in a while, as the sector completes a large degree corrective consolidation, which we believe to be a wave 2 in Elliott wave parlance. There is more to go, but it is time to put this sector back on your radar screen. As such, I'd like to cover the areas outlined here. For our new subscribers, and as a refresher for others, let's start with a highlight recap of our tracking of this sector and why we are constructive on it. We first showed this chart in 2019 when our interest in the sector began. We always look for value, especially when the distortions get as significant as this. We initially got serious in the fall of 2020 when we published the October 2020 LONGWave edition entitled 2021 Year of Hard Assets. Though we felt it wasn't quite time to enter in the fall of 2021, we continued to research the sector as more and more telltales became obvious to us. On February the 2nd, 2021, we then published this chart suggesting we felt it was a high probability entry point. First, long cycles as represented by the domes were supportive. Secondly, a long-term ending diagonal looked complete, with a decisive price breakout having occurred. 3, our Matasi proprietary momentum indicator in the bottom pane was clearly showing overhead resistance had additionally been broken. And 4, we felt the next stop over the next 12 to 18 months had a good probability of being significantly higher, shown by the yellow overhead resistance level in the chart. Well, that is exactly what happened. We published this chart 13 months later in March of 2022. We felt there was a little more to go, but cautioned we were approaching an intermediate term peak. 3 months later, in the June 2022 LONGWave video entitled Peak Inflation versus Gold, we talked about inflation topping and what it meant for commodities like gold. In the first newsletter that went out with this video, we published this chart suggesting the intermediate top was likely now complete for commodities. 2 months later, in the August 2022 edition of the Under the Lens video entitled Geopolitics of the Commodity Supercycle, we felt though the corrective consolidation was occurring, there was significant structural geopolitical events occurring. These developments would eventually lead to even further attractiveness of the sector when the technically driven corrective consolidation was completed. Technically, the overall sector had just come too far, too fast at that point. The commodity sector is a big sector with a lot of moving components within it, as this title slide attempted to illustrate. That was a highly abbreviated recap of what has occurred. So the real questions facing us are: 1, where do we now stand? 2, what should we expect? And 3, what will be the key drivers going forward? You can see it turned out we got the price level of the top pretty well and within our initial 12 to 18 month prediction, 16 months to be precise. The corrective consolidation we're still in should last anywhere from 30 to 48 months in total, according to its cycle frequency pattern. If the ABCDE triangle we appear to be developing, as shown here, is correct, the correction will end in the area of this coming February, not long after the inauguration of a new U.S. president, no doubt with their economic stimulus deficit spending plans. So far, everything we have been showing is using the CRB commodity index. Let's look at some other commodity indexes. Here's the Goldman Sachs commodity index, showing it may possibly end earlier, but within the overall time frame. If we look at the Bloomberg commodity index, it is more reflective of what the Goldman Sachs index is showing and is suggestive of a bottom later this fall. So what would drive the reversal and the beginnings of the Elliott wave 3 count up? Well, increasing deficit spending and a consequential weakening U.S. dollar no doubt would certainly do the trick. However, there are further structural changes occurring. We have shown this schematic on the right many times before. It reflects our current expectations that we should expect another 2 possible inflation waves through the rest of this decade. The next wave is most important to us. It is likely to be driven by rising services, as delivered by skilled wage pressures. Rising import costs, tariffs, which both president candidates are talking about, are highly inflationary. Rising energy costs, regulatory energy impediments are crippling public utilities really around the developed world. And 4, rising food costs. There's a shortage of agricultural land and regulatory restrictions that are causing significant problems and a decrease of the actual amount of farms that are in operation. Wave 3 is likely to be more about rising shelter costs, that is shortage and rising property tax rates, and a falling U.S. dollar as a result of overall currency debasement. The markets are already starting to sniff this out. Although inflation, as measured by the CPI, has fallen in its rate of increase, it is now flat. Commodities, as measured by the S&P 500, GFCI, Equal Weight commodity sector, are already rising. The well-followed and accurate Bank of America chief strategist Michael Hartnett feels that, and I quote him, that while most commodities appear to be in a secular bear market right now, once again, largely thanks to China's economic slowdown, that is about to change. That is because the secular commodity bull market in the 2020s, 11% annual return so far, is just getting started. As debt, deficits, demographics, reverse globalization, AI, and net zero policies are all inflationary. End of his quote. This means that commodities are a better 40 than the bonds in the 2020s for the 60-40 balanced portfolio approach. And sure enough, total returns over the past 4 years demonstrate that. 30-year U.S. Treasuries at 39% increase, which have been outstanding, but commodities have been 116%. Commodity index annualized to 10 to 14 returns, even amidst falling inflation, and a dovish Fed with AGG just about around 6%. If you look at the asset quilt shown here, commodities after 2 years at the bottom have no place to go from here but up. It isn't just a commodity. S&P is historically weak, but additionally how long it has actually been this low. Typically, an Elliott wave principle, wave 3, is the largest wave in terms of price. Very importantly, we see inflation drivers while we are witnessing structurally retreating disinflation elements. These are important drivers. The potential commodities Elliott wave 5 wave count may actually be signaling something much bigger and more strategic in nature. We have long held that we are in the midst of a very important advancing transitional shift from a unipolar world of primarily U.S. leadership to a multipolar world competing with other major factions such as BRICS and their member states. Charles Hugh Smith and I put together a macro analytics video entitled Tectonic Shift, Mercantilism Revalued, where we explored the impact of the growing importance of the BRICS and their rapidly expanding member states. Just as an aside, all videos that I mentioned here can be found in the public domain on YouTube. I encourage you to review it as you do your commodity due diligence, since it covers a lot of key ideas about the evolution of the global commodity nations, as initially colonies supplying the imperial nations, and their transition to today's modern industrial world. These nations now are both consumption economies and burgeoning industrial niche players. We are now in the early stages of a period which Charles and I dubbed the era of revalued mercantilism. This is an era where mercantilistic economies that had succeeded by exporting their production to dominantly the U.S. are finding it ending as global economic stagnation becomes more prevalent. The fact is that dependence on mercantilist exports for growth distorts the domestic economies of the dominant mercantilist economies such as Japan, China, South Korea, Germany, and the names go on. These are at least the big ones. Mercantilistic economies seek domestic growth at the expense of other economies by heavily subsidizing exports. As global growth slows and cheaper competitors arise, for example, Vietnam, Pakistan for clothing, assembly, etc., the mercantilist economies have nowhere to go but down as they optimize their economies by a massive subsidies to rely on exports for growth. Once global growth declines or cheaper competitors arise, then the path of decline is set. Japan is showing the accumulated overseas wealth can support stagnation, but neither South Korea, China, Germany, or other mercantilistic economies have the same massive stock of wealth to fund their stagnation. This is likely to result in commodity nations having more leverage in attracting new industries, as well as shifting the importance of producing to actually being the supplier of the key physical materials or commodities. Elements of reshoring, deglobalization, and definancialization will all benefit the ever-increasing importance and value of commodity producers. Commodity and material suppliers are heavy users of energy. With developments in green and renewable energy, the commodity countries' dependence on imported coal, oil, natural gas, and refined fuels is likely to be better balanced and less burdensome to their developing economies. Standards of living rise when energy costs fall and become more abundant. With the BRICS consisting initially of the larger nations such as Brazil, Russia, India, China, and South Africa, they have now expanded to include on the 1st of January major countries such as Egypt, Ethiopia, Iran, and the United Arab Emirates, while on September 2nd, Turkey officially applied to join the bloc. The China-led Road and Belt Initiative, the Shanghai Cooperative Organization, and the African Free Trade Agreement have all added to the scope and reach of the BRICS 10 consortium. The reach is now broad and captures significant global market shares of GDP, population, oil production, and goods exports. But most importantly, we have approximately 138 countries, or 3/4 of all countries on the planet economically dependent on the export of commodities, rushing to join the BRICS trading structure. In many ways, they feel they are being treated as feudal mercantile slaves of old through Western imperial pricing. Never forget that in an era of fiat currencies dominated by the major Western economies, wealth can only be created by growing it, mining it, or building it. All three are held hostage by the real tangible wealth of the commodity nations now. BRICS 10 are acutely aware of this, as they effectively are creating a new, powerful global cartel along the lines of OPEC. At least this is what we see. OPEC is about oil. The new, much larger cartel is seen to be about commodities. What now is referred to as the Southern Nations is about an organizing structure to leverage their natural resources and their export products' value. China's Belt and Road Initiative is exploding with new signatures that bring these countries into an organizing structure with commitment on bilateral trade, de-dollarization, and financial systems other than the U.S.-controlled SWIFT system. All of this will lead to structurally rising values of commodities. As global conflicts are likely to increase along with tariffs, we should also expect to see commodity scarcities. Choke points for scarcities will come from many points of attack, potentially. Transportation routes, strategic minerals, limited commodity suppliers in specific areas, country regime changes, production lags, country environmental regulations, lithium, cobalt, nickel in solar panels, rare earths and silver in technology, uranium in nuclear energy, and the list goes on, are areas that are likely only going to propel commodities higher even in the period of potential economic stagnation beginning to occur in the advanced developing economies. What is the conclusion here? It's important to start doing your due diligence, as this is an incredibly large sector of products and opportunities. It will take time, which you currently have before the Elliott Wave's Wave 2 finishes its corrective consolidations. It is not time yet to invest in our assessment. It's time to do your homework. It may potentially be one of the best investment ideas over the remainder of the decade. Only time and unfolding events will tell for sure. Currently, I like the probabilities here. As I always remind you in these videos, remember politicians and central banks will print the money to solve any and all problems, until such time as no one will take that money or it is no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has actually seldom been a better time for investing. However, it requires careful analysis and not necessarily following what has been traditionally the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2024 turn out to be an outstanding investment year for you and your family, and I sincerely thank you for listening.